Okay, folks, tax class. I knew there would come a day that out of 6 people that I'd have no one in class. So I guess I'm the only one here today. Hillary and Terry and Matthew usually live stream. I got a text from Cole that he couldn't be here. And I guess for some reason, Jonathan and Clayton couldn't be here. I just got a text from Terry that she's here. But anyway, no one's in class today, so it'll probably be a shorter class than usual, but we do have to cover a few things. If you have your textbook, page 824, bad debts, and looking over some of the rules for bad debts, the bona fide and debtor-creditor relationship must exist. The taxpayer must have a basis in the debt. The debt must actually have become worthless during the year. The type and timing of a bad debt depends on whether the debt is a business or non-business bad debt. We know business bad debts we've had in accounting principles and intermediate. When you set up an allowance for bad debts, in a merchandise business, there's lots of bad debts. And it says generally taxpayers may use the Pacific, which is the direct write-off method. I think that's the method you should use. Bona fide debtor-creditor relationship, we know that accounts receivable and accounts payable give rise to bad debts, no problem. But if it's a related party transaction, determine whether a bona fide loan transaction has actually taken place is especially critical in the transaction between the taxpayer and a family member. You should have a contract. You should have interest set up. You should have regular payments set up to make it a bona fide bad debt. On page 25, does a note or other written instrument exist which evidence an obligation to repay? That's what I was talking about. Regular payments, payoff date, interest rates. Have the parties establish a definite scheduled repayment? As the parties document a stated reasonable rate of interest? Would a person unrelated to the debtor make the loan? And please look over. Now, sometimes when you forgive a bad debt, it's just a gift. If it was to a relative and you forgive it, it's a gift, and it's not a bad debt. Third-party debt, you cannot take that off unless you're responsible. Your basis in the debt, such as accounts receivable, accounts payable, can be established. On page 26, the debt must be worthless. Well, if a company goes bankrupt, it's worthless. If a taxpayer dies, it becomes worthless. If you've tried every means of collecting, it becomes worthless. But on page 26, look at non-business bad debts. The distinction between a business bad debt and a non-business bad debt is important because the classification of the debt determines its tax treatment. A business bad debt gives rise to an ordinary deduction, whereas a taxpayer must treat a non-business bad debt as a short-term capital loss. So if you're not in the business of making loans and you make one, you got a contract, you're not in business of making loans, you wouldn't do a Schedule C or a business return. You'd take it off as a short-term capital loss. Loans made by a corporation are assumed to be associated with the corporation business. Therefore, the provision for non-business bad debts do not apply to corporations at all. And it gives you a definition of a non-business bad debt on page 28. A non-business debt is defined as any debt other than a debt created or acquired in connection with a trade or business. A debt, the loss from the worthlessness of which is incurred in the taxpayer's trade or business. The determination depends an examination of the facts and circumstances surrounding the death. So please read those examples, such as on page 27, example 34, example 35. All right, business bad debts, you just deduct against accounts receivable, or just take it off as worthless bad debt. Okay, a net operating loss, I wanted to look at that a few minutes today on page 28. All right, if you're in a sole proprietorship, you can have a loss. If you're in a partnership, you can have a loss. If you have a corporation, you can have a loss. That's called net operating loss. All right, but how much can we deduct? Look at your page 30. It will give you computation, the net operating loss for individuals. Okay, for individuals, look at page 31. During the year, Nancy, who is single, has taxable income. She has gross income from a business, and she has gross expenses. So she lost $24,000. Now, plus she has interest income and dividend income. So now she has lost $22,900. That's in her business. Can she take it all? We've got to see. Now, when she does her itemized deductions, now this book shows 11,000 or standard deduction 63. Well, we know that your new laws, the standard deduction would be 12. So she'd take the standard deduction. But right now, we're going to follow the book. She's got 11,000 in itemized deductions and 4,000 in personal exemption. That is 15,000. That will not be so on the 2018 tax return. She will get 12,000 standard, and she will not get an exemption. So she will get a solid 12,000. That would make the loss not 37,900, but would make it 34,900. 22,900 plus 12, yeah, would be 34,900. Now, can she take that 34,900? No. Her net operating loss for the year is computed as follows. We'll use the 37,900, itemized deductions, casualty loss. So she's going to take out 10,000 of itemized deduction. She does get to casualty. She's got to take out to 1,100 interest and dividends from the casualty. From the itemized deduction, that leaves 8. She gets a personal exemption. So her net operating loss is 25 according to 2017 taxes, but not according to 2018. It would be less than that. It'd be 3,000 less. So it would be 22,000 is what she'd get to take in 2018. So please look at example 42 and 43. Now, carrybacks and carryovers. An NOL is initially carried back for 2 years. So for 18, you'd go back to 17 and 16. Except as noted below, taxpayers must carry the loss back first. If any loss remains, taxpayers then carries it forward for 20 years. Furthermore, in both the carryback and carry forward periods, the loss must be deducted from the years in chronological order. Thus, if a net operating loss is obtained in 2015, it must be carried back to 13 and 14, and then you go forward to 16 and 17. Now, election to forego carryback period. You may elect not to carry back the operating loss, but to carry it forward. When you make this with respect to an entire carryback, does not extend the carry forward period beyond 20 years. So I still suggest you carry it forward 20 years. you're going to make any profit at all, that ought to eat up this loss. And a loss this year will help you on your taxes next year and maybe even the next. All right. Cash and losses we have mentioned. Well, come in, Hillary. And we have mentioned net operating losses and worthless securities. We mentioned bad debts and so on. So that wraps up chapter. Hillary, you're it. I've been talking 15 minutes to myself, but I'm recording. I looked over in 15 minutes this chapter on net operating loss, and we're going to start practicing problems, of course, in this chapter, and at least, put in better than half the period, I hope. I hate to lose the whole period. But Cole can't show up, and I guess Jonathan Clayton couldn't either. It leaves just you. I got a text from Terry. You got your test finished the other day, didn't you? Okay. I haven't graded it yet, so we're going to start looking at some even problems. Chapter 8. I've got a lot of these marked. Hill, do you remember how many of these I went over? Chapter 8. Did I pick up the wrong book? I picked up 2016. So let me get my 2019. That's 3 years old. The laws should not have changed. What I talked about should not have changed. But when I saw those problems, I knew something was wrong. The books look just alike. So now we were talking about passive activities the last time we were on this chapter. So look at passive activities if you would. We looked at casualty and theft losses, and that brought us up to bad debts. The rules are the same on page 24 and 5. And we looked at non-business bad debts at the bottom of page 26. That brought us up to net operating loss on page 30 and 31. Now we'll see, if you look at that example, page 31, example 41, let's go back where Nancy had a business loss of $24,000. She had interest income and dividend income, so she has a loss of $22,900. That's just like the 2016 book 3 years ago. She's got interest and taxes, and she's got total itemized deduction this year of $14,000. Now, does she take that or the standard of 12? This book does have the standard 12, no exemption. So she's got a loss of $36,900 this year. But how much does IRS let you take? All right, they're going to take your itemized deductions of 14. They're going to give you the casualty, so you got to take out 13. However, they're going to reduce that by non-business income of 11. So she has to take out 11,900. So she gets to take 25,000. And once again, she can carry that forward 20 years. She can carry it back too if she wants to, but I promote taking it forward 20 years instead of back, because you're going to go back and do amended return. So at the end of this chapter, it was the same. And now it brings us up to the problems on page 37. Now, we're going to look at a few problems. Since Hillary's the only one here, I won't pick on her, okay? I'd have to ask her every question. So give me a minute to bring up these solutions. All right, for this chapter. Hillary, is this the first time you've been in a class with one student? My first time too. First time for everything, if you live stream. Of course, a lot of people who do 100% Blackboard or Moodle, and some of them will just throw PowerPoints on there, and they'll throw maybe solutions, they'll give assignments, and they may have you using Cengage. Cengage grades your assignments, and the instructor don't have to do much. But back in the old days, when this thing first started, the instructors would go into a AV center and record a lecture. And then students could check it out on an 8-track, and later it became a DVD, and so on. But then the instructor had the lecture. But I think online classes are easy for the instructor. If they just use PowerPoint and assignments, and if Cengage grades your assignments, they don't have to do that. They can even put tests on Blackboard and Moodle, and the company grades the test. They don't have to do much. So it's easy. But anyway, that's the day and time that we're living in, and that's the day and time that we'll put up with. Okay, now we're going to look at number 38. No, number 40. Amount and character of the loss. On September 30th for the current year, Fox Corporation filed for bankruptcy. At that time, it estimates the total fair market value of its assets at $725. The total amount of the outstanding debt is $950,000. So Fox Corporation has been engaged in the resale of tax preparation, tax research related books. At the time of the bankruptcy, Fox is owned by Randall, who purchased the stock for $250,000 several years ago. Randall is single. What are the amount and character of the losses sustained by Randall upon Fox bankruptcy? Well, if Randall does not get anything because your assets are less than your liabilities, there'll be no value left. His stock is worthless. He should be able to deduct the whole $250,000. All right. Because Fox is insolvent, all of its assets will go to debts, leaving none for Randall. Randall will not recover anything. He paid $250,000. The stock does not qualify as Section 1244 stock. He will suffer a $250,000 long-term capital loss. He can only take $3,000 a year. If he got it Section 1244 stock, he could have taken $50,000. Now, how would your answer to Part A change if Randall originally organized Fox himself? All right, and he put $250,000 cash in it. Now that's where Randall would get to take $50,000 as an ordinary loss and $200,000 as a long term. He could take $50,000 this year instead of $3. How would your answer change if Randall were a corporation instead of an individual? Since at least 80% of the voting power of Fox stock is owned by Randall Corporation, and more than 90% of the receipts are from business operation, $250,000 loss, you'd take it off. One corporation would take it all if they own part of another one. How would your answer to part B change if Randall were a corporation instead of an individual? Same as part C. You'd take it all. All right, you take it all as a ordinary loss. Okay, now that was pretty much the section 1244 stock. Now we're going to look at number 42, a passive. In the current year, Alice reports $150,000 of salary, $20,000 from activity X, $35,000 and $15,000 losses from activity Y and Z. Okay, we had 20 profit, 35 loss, 15 loss. Now that's a $50,000 loss. Minus a $20,000 gain, we've got a $30,000 loss. They're all passive with respect to Alice and are purchased during the current year. What's the amount of loss that may be deducted with respect to each of these activities? But first off, we should be able to take 20. All right. As I told you, we had 20 gain, 15 loss, and 35 loss. Well, wait a minute. Did I make 50? Did I look at that amount wrong? Now, 1535 is 50. And 20 gain, that leaves 30. I read it wrong. Okay, it's clearly 30 difference. Now, how do we allocate that? We got a $30,000 loss. So 35 over the 50 is 23,000 attributed to one. Oh, 21. And then 15,000 divided by 50, you can get a percent times the 39. So that's the activities we allocate them to, but it's still a $30,000 loss total. Now, these losses carry over to subsequent years and may be used to offset any income from these activities. Additionally, any remaining loss attributed to activity that is disposed of may be deducted in the year of disposal. So we do carry them over. And if next year activity Y has a $10,000 gain, you can take it away from the 21 loss and still carry over 11,000 loss. All right. But if you disposed of activity Y, you can take the whole loss. This is why it is important to allocate the portion of the total net passive loss carried back to each item. That's why we're doing this, because you may sell this bunch of apartments and keep this bunch of apartments, if it were apartments. The word passive means you do not materially participate in that business. Okay, a few more problems. We'll look at number 44. Okay, during the current year, Irene is a married individual who files a joint return, reports the following items. Salary, good. X, she got 10,000 gain. Y, a $30,000 loss. Z, a $20,000 loss. That's a total loss of 40,000. All right, Irene actively participates in Y and Z and owns 100% of both Y. Now, she actively participates in those two. Now, is that going to make it passive or non-passive? Now, looking at the nuts and bolts here first, she has, that's 43, isn't it? All right, here's her salary. All right. Now, over here, maximum rental estate loss in 1 year is 25. That's given. But you phase that out, so much a year or so much. She made 130,000. Your base is 100 times 50%. So 50% of 30,000 is 15. So she gets to take only 10. Only 10. So you can read about these two little rules and the 50%, 100 in the book. But now B part, we know we've got 50,000 loss. And we had $10,000 gain. Again, we have to allocate this. This 30,000 net loss would be 18 for one activity and 12 for another, just like number 42. $46, another passive. I'm gonna skip 46 for the time being. We'll get that when more people get back. But we're gonna look at 48, a casualty loss. Now, on a casualty loss, Tony is a carpenter. He owns the furniture manufacturing business. During the current year, a tornado, a federally declared disaster, damaged several pieces of equipment and destroyed the delivery truck and his personal automobile, which he kept in the garage. Now, look at the assets. Equipment A before the casualty was worth $12,300. After the casualty was worth $4,000. The cost to replace it, that'd be $83,000, but he replaced it for $87,000. Repair. His adjusted basis was $9,000. Insurance proceeds is $37,000. Now that gets a little complicated. The biggest loss he could have is his basis of $9,000. He gets insurance proceeds of $37,000. Added on to the fair market value after the cash would make it $77,000. So let's look at that one in detail on a casualty. Skip 46. And we went to 48. Now, equipment A, they put these on a sheet here. The decrease in fair market value is $8,300, which is listed as adjusted basis. Because the decrease in fair market value is available, the cost to repair the equipment should not be used. The deductible loss is the amount of loss not compensated for by the insurer. Now, the decrease in fair market value was $8,300. Insurance gave you $37,000, so you get to take $46,000. So please compare that and see why you got to take $46,000. And B part, the decrease in fair market value is $81,000, but it's limited to his adjusted basis of $3,000. So he really has a gain. $7,800 minus $3,000 gives him a gain of $4,800. Okay. All of the gain is probably attributed to prior year depreciation. At will be recaptured. It will be ordinary income. So he had a gain on equipment B. Equipment C, we don't know what the fair market value decrease. It's not available. You can use the cost of repairing the asset. All right? Assuming total repairs on equipment C meets the requirements, the deductible loss is $2,400. So that's 13.8 cost of repairs plus 11.4 insurance proceeds, $2,400. Now on the truck, its base is 17.5, but he got 16 out of the insurance company. That's easy to see. His loss is only 15. And you can see your net loss is minus 8,500. Now, since it's a business loss, you take all of cash, 100%. 100%. But this problem illustrates well all this insurance proceeds. All right, now let's see. AGI is 80. Take out 8,500 casualty. That leaves 71.5 AGI. Personal casualty loss 300. But now on that personal casualty loss, you take out 100, plus you take 10% of AGI, 71.5, and you get nothing on the personal casualty loss, zero. We'll look at another casualty loss. We'll look at number 50. We'll get people back. Well, let's look at number 49, a theft. On December, the current year, Kelly's business office safe is burglarized. The theft is discovered a few days after the burglary. 3,000 cash from the cash register is stolen. A diamond necklace and a ring that Kelly Franklin wore are also stolen. The necklace costs $300, but it's insured for $600. Fair market value, Kelly purchased the ring for $3,000 2 weeks before the burglary. Unfortunately, the ring and the cash are not insured. Kelly's AGI for the year, not including the ring and so forth, the other items, is 70. All right, now let's look at number 49. 3,000 cash is a business asset and is deductible, no problem. The ring and necklace are both personal items. Thus, the loss on the ring must be netted against the gain on the necklace. Now, the necklace, she only had $2,300 in it, but she got $6,000 insurance. So she had a gain of $3,700 on the necklace. Now, the ring, she has no insurance on it. You take out that $100 floor thing they give you, she's got a minus $2,900. So you got a net gain from insurance of $800. Since Kelly has an $800 net personal casualty gain, the $3,700 gain on the necklace is reported as a long-term capital gain, and the $2,900 loss on the ring is reported as a short-term capital loss. Since net gain was reported, there is no reduction for the 10% floor. Well, that's good. She escaped that 10% floor because you had a gain, naturally. The B part, 0. Theft losses deductible in the year of discovery. Okay, in the year of discovery. I guess that was a question. What is Kelly's deductible theft loss in the current year if the theft is not discovered until January of next year? Be 0. You report it next year. All right, we're going to jump up to 52 and 54 on bad debts. Number 52, page 40. Elaine is a physician who uses the cash method of accounting for tax purposes. During the current year, Elaine bills Ralph $1,200 for office visits and outpatient surgery. Unfortunately, unknown to Elaine, Ralph moves away, leaving no payment and no forward address. What was the amount of Elaine's bad debt deduction? All right. If you're on the cash basis, there is no deduction. You'd have to have it a debit to accounts receivable before it's bad. So let's see what they say. Okay, they said what I said, 0. If you never counted his income, how can you take a bad debt for it? But on the accrual basis, she could have taken a bad debt because she had reported. Now let's look at number 54. Assume the same facts as problem 53, which we didn't read, except that Becky and Ken are related and that under the terms of the loan, Ken agrees to repay Becky the $5,000 plus interest over a 5-year period. What is Becky's bad debt deduction for 2018 or 2019? Well, we didn't do number 53, but it's 0. It's only partly worthless. And 2019, she can take the $4,500. Since it's a non-business bad debt, no deduction was available in 2018. All right. These problems, we've looked at some key points in this chapter. Number 1, passive losses. Here, bad debts. And also cash losses. So this chapter, we had passive losses, cash losses, bad debt losses. Then we're going to have a net operating loss. So let's look at least one net operating loss this period. That'll probably be number 55. Then we'll look at 56 and 58 come Tuesday. Okay, so here's the story. Michelle and Mark are married. Now, Mark's salary is 18, interest earned 12, interest paid 12.7, itemized deductions for state whatever taxes 94, items related to Michelle's dental practice, revenue 65, payroll 49, supplies 17, rent 16 something, advertising 4 something, depreciation 4 something. What is their taxable income? Well, we know they've got a loss. If you've been in accounting at all, you can see those numbers add up to more than you made. So here's the story. You have revenue of 65, payroll of 49, you have supplies of 17, rent of 16, advertising 4, depreciation 81, and here's what we want to come up with. A loss of 30,100. Now, his salary is only 18. His interest earnings is 12. So now we've got a loss of 10,900. All right, we at least reduced that loss from 30,100. Now, interest paid, itemized deductions for state and local taxes. Now, the standard deduction for a married couple is 24, and that's much better than 22.1. So now we've got a $34,900 loss. Okay? But IRS is not going to give you that $24,000. They're going to let you take non-business income from that, and you're going to lose 22.8 of your standard deduction. So your real loss is 12.1. And that's what IRS will let you carry forward 20 years and use it against next year. And we'll look at 56 a little better. I don't know what's changing here. 10.9 is the same. Down to here, it looks the same. However, itemized deductions. Yeah, they got 4,500, don't they? That's what changed. Now look how that changes the outcome. Now, 12.1. Now what if I add 4,500 to that? What would it make it, Hillary? 12.1 plus 4,500 be what? 16 what? It's 16.6, wouldn't it? Well, let's see if that's what happened. All right, you get to add the cash loss to your losses. And right here, it reduced your itemized deductions, sure. And of course, it reduces your itemized deductions and reduces your non-business. But bottom line, it was 4,500 difference, wasn't it? Okay, then Hillary and everybody out there that may be watching today or sometime, we're just going to go ahead and stop broadcasting today. We've lost a half an hour of class, but I feel like you all gave me that back the day of the test because some of you stayed an hour late. Okay, so over and out. I'll see you all Tuesday. You should read the next chapter 9 real well, and we're going to finish up chapter 8. And chapter 9, you can start working the even problem.